4, 3, 2, 1. Buckle your seatbelts, batten down the hatches. Coming to you live from the Blazar Podcast Studios in Space City, Texas. It's time once again for the Capital Catalyst Show, the podcast for entrepreneurs to learn the secrets of attracting, raising, and closing capital from high net worth investors. Dedicated to your success, this is the Capital Catalyst Show. Now here's your host, Brad Blazar.
Hey, welcome back, listeners. It is your host once again, Brad Blazar, coming to you live from Space City, Texas, where we host every week the Capital Catalyst Show. Today, I've got a really great guest. This gentleman is just crushing it in the multifamily space. I want to introduce Jonathan New, a former commander in the United States Navy that found his place in real estate and is now a director with Fairwinds Capital. So welcome to our show, John.
Hey, thanks for having me, Brad. It's a pleasure to be here.
Absolutely. You know, what I love about your company is you guys basically all came together where, if I understand correctly, the principals with Fairwinds are all former military. Is that correct?
That's absolutely correct. I'm actually still active duty Navy. I'm in my twilight tour, which means I don't really have a lot to do except for just focus on some Fairwinds. But
Okay.
Corey was, he retired from the Navy about a year ago, and Vadim got out most recently, and then Jaspreet was a merchant marine. So we've all got our roots in that military, and that's where we developed our sense of bringing quality to other people's lives.
I love it. Now, did you guys know each other in your prior lives before coming together and starting the company?
Well, Corey and I were doing some single family stuff individually up in Hampton Roads, Virginia, and that's when we got together in local meetups. So same with Vadim, but Vadim was smart and actually got straight into commercial real estate. Skipped the whole residential phase all by himself. Good guy.
Gotcha. Well, you know, it's interesting. I've got 3 siblings. I've got 2 sisters and a brother. And as long as I can remember, my brother always wanted to be a Navy SEAL, and found out, I guess, as he got, later in life, that he just wasn't able to qualify. And then, of course, the idea of being a plebe and have to go through, SEAL training out there in California, it just to say he wasn't cut out for it. So a good friend of his that was a journalist major said, Ernie, you could pretty much live the life of a SEAL by being a civilian journalist for something called the Navy Times. And so he actually became a journalist for the Navy Times. And I'm sure a lot of the articles you probably read, perhaps when you were enlisted, he wrote. But he got to do some pretty amazing stuff, go in subs, aircraft carriers, was lowered by cable from a Sikorsky to the back deck of a carrier, and, did all the cool stuff I guess he wanted to do as a SEAL, but never had to go into combat, didn't have to risk his life. But he enjoyed those, I think it was 4 or 5 years where he was with the Navy Times, getting to travel with you guys and doing some pretty cool stuff.
That is awesome. That is really, really awesome.
Yeah. So anyway, so let's talk real estate. Let's talk capital raising. Let's talk about what you all do. I guess the big question is, at what point in your life did you realize you wanted to get into real estate? More importantly, why did you make the decision to do that?
So, great question. When I was deployed to the Middle East, this was 8.5 years ago, I actually missed the birth of my second son.
Oh,
and
wow.
that was the point. Well, we all get into the Navy and the military knowing what the sacrifice is. You might have to miss the birth of your second son, but you never know what it actually feels like until it happens.
Sure.
And that was kind of the point that I realized that I would rather be present for my family, and I put my like command aspirations aside and focused on being present with my family. And it also kind of chopped the legs out from underneath my ceiling of my Navy career. So then I started looking into different options for post-Navy careers, and that's when I discovered like bigger pockets, like most everybody does. And I was like, oh, the Burr method, this is so fantastic. I'm gonna get like 5 houses. It's going to be crazy. And then it became 50 houses. Then I was doing 5 houses every single month. And then it got to be like just too much. And then that's when I jumped into a team and commercial real estate.
I love it. Yeah, I think that's how most of us get started. I started kind of same way. It wasn't necessarily the Burr method. Like a lot of people, I wanted to get into real estate, but I didn't want to put a lot of money at risk. And so I learned about subject twos. And, like a lot of people started nailing bandit signs up all over town, started getting the magnets for the side of the SUV. We buy ugly houses, but here's the funny thing. Lo and behold, it worked. I started getting phone calls. People that were in foreclosure started calling me. And so I started going out, meeting with people in their homes, started calling out to lenders on their behalf, basically talking about forbearance agreements and loan modifications, and ended up taking well over a dozen properties. And then much like you, I realized, man, that I was just spread way too thin. I was like, there's got to be an easier way to be a landlord than basically multiple properties spread all over Houston, Texas, where sometimes it's an hour and a half drive from one location over to another to meet a contractor or meet a plumber or, whatever, HVAC repairman. And I realized that, I could basically get, quote, the same number of tenants in one location and simplify my life by basically getting out of single family, moving into multifamily real estate.
Preach
So
on.
that's
On.
that's the holy grail. So talk to me a little bit about, the capital raising. Obviously, capital raising is a big part of real estate. You need money to make money, whether it's the Burr method, whether you're getting into single family, whether you're doing big stuff like that. But talk to me a little bit about, how you go about getting people interested in what y'all do there at Fair Winds.
So completely different than what I was doing, raising money when I was in the residential space, when it was just a loan here or there. But now, obviously, we do the 506, 506Bs, 506Cs. We've gone from mostly friends and family in the 506Bs to the Cs, so where it's all accredited now. But we do get to advertise at this point, which is fantastic. So we have got we still use co-GPs to help us raise on our syndications. But we're doing a lot more focused raises by ourselves these days, using, of course, the Syndication Pro. We've got a marketer who blasts out to emails and SMSs and all that stuff. I'm not a marketer myself, so we brought in Vikram with Markham 18 to do all that for us.
Gotcha.
So we do have two people that are focused mostly on raising piece. I myself am more of the acquisition part of the team, and trends, going on to podcasts and developing the brand as well. So we have our investor relations piece, with one person does all the investor relations, and so that's kind of how we tackle that big bear that's just so important in this industry. I don't think it's common or indifferent than other teams. So it's kind of divide and conquer, really.
So let's say you get a lead, it comes in, somebody clicks the link, they see one of your ads. What does that look like? Do you have, I guess, a person that maybe takes that first call, or maybe the first and second call, and then maybe passes that off to one of the more seasoned principals, perhaps like you or somebody else in the company? Or is there one person that kind of handles that entire relationship that ultimately closes the investor?
So we do have the one email that goes out to the like the prep email, and that will trigger them to schedule a call with specifically Vadim, who's our investor relations guy. And then we will not always, sometimes, like a lot of these investors are people that I bring in specifically. You meet them at meetups and they come in, and then you develop that relationship with them a long time. We try very, 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 very hard not to be transactional with our investors. We do have 676 investors in our portal now, so it gets very challenging. But we also so we develop that relationship that way, get to know the person, what they're most interested in, and then we do follow-up emails and calls and texts with them. And we're going to start doing Christmas gifts and random gifts coming up here pretty soon. So just to keep Fair Winds on their minds and make sure that we are actually thinking about them. on an individual level as well.
Yeah, I mean, it's a series of touches, there's no doubt about it. How many calls or Zooms or meetings are you finding it typically takes to take somebody that's a cold prospect, meaning they don't know you, you don't have a relationship with them, to get them to the point where ultimately they're writing a check? What is that process going to look like?
That is a great question. It really depends, but I'd say round 3.
Okay, yeah, that's about right. Yeah. Yeah, we talk about something in our Capel School mentoring called the 4-step blueprint. And, one of the biggest problems that I see people make all the time that are trying to raise money, that are floundering and ready to just throw their arms up in despair and give up, is I ask them, like, well, how are you going about the process? Like, tell me what you're doing. And the big mistake they make is they pitch the deal way too early in the process. There's not enough foundational trust. There's not a relationship that's really been developed yet. And so, out of respect for you, that other person says, well, this sounds pretty exciting. Can you send me something to take a look at? Which you do, thinking that they're generally interested. That's just the next step in the process. But when you try to close them, they're very evasive. And it's not that it's a bad deal. It's just that they don't trust you enough. They don't know enough about you, and more than likely probably don't know enough about them to really get them to commit. And so I tell people the big thing to realize is this is not a sprint. This is a marathon. You really need to understand that people invest with their heart emotionally, and then after they write a check, they justify it logically with their brain. So spend a lot of time, kind of like you are. The first call is more of an introductory call. The second call is going much deeper with them. Maybe you try to validate that there's enough trust there. We talked about something called a validation phrase. And then the third call, usually you're pitching, and the fourth call, you're closing. Hopefully you're getting a capital partner and you're getting an investor on board. So it's a pretty similar process for sure. Absolutely.
Yeah, I mean, sometimes I've even have to fly out to a property to meet investors, and it's worth it.
Yeah.
It is. I mean, that's what closes the property or closes the investment. It's worth it.
Yeah.
Or flying out to Houston sometimes, or San Antonio,
Sure. Absolutely. So do you have a certain focus, I guess, geographically on the markets you're wanting to invest in, or are you somewhat agnostic where it's more about the deal?
No, we definitely want to be more focused. Like for deals that we sponsor,
Mhm.
it has to be someplace that we've either got a footprint or we live in. So I live in
Okay.
Jacksonville, so we focus on the middle, that northern middle part of Florida. We've got
Sure.
partners in Hampton Roads, so DC down to Norfolk,
Yeah.
Virginia. And of course, we've got a big footprint in Houston and San Antonio. So those are really the markets that we're focused on for a sponsorship.
Mhm.
However, when it comes to like a co-GP where we raise money from, it's really all about the sponsor and the deal itself, of course. So we've got some deals out in like we're working on a Reno, Nevada deal, as well as more Houston stuff, and then in oh goodness, up in like Maryland.
Gotcha. I know. I understand. So let's talk a little bit about financing real estate. Obviously the rise in interest rates has had a big effect, right, on real estate valuations. How are you guys dealing with that challenge in terms of, a lot of sellers just not realizing that, hey, prices are adjusting. It's not the same market it was 12, 18 months ago. How has that affected
Yeah,
your pipeline?
that is fantastic. So one of the deals that we're co-GPing on right now is a HUD loan. So it's an assumption. It's at like 2.75% interest rate. So because it's HUD, obviously. So the loan assumption deals can be very appealing right now, but at the same time, brokers are using that to say, all right, so give me my 2 cap, because I can still demand a 2 cap because it's loan assumption. A 2 cap obviously is exaggerated, and I would never pay a 2 cap for anything.
Yeah.
But so loan assumption is one way that we're looking at different options. Our exit cap has gone. It's still much higher than it was, say, a year ago.
Sure.
For our assumptions and our underwriting.
Right.
But another thing that we're looking at doing is like seller financing, sort of like almost like subject twos in a way. So just some like creative financing type situations. It's very, 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 very rarely accepted just because the owners want to get out and get their money and get it now. And but they're obviously still stuck in Q4 2021.
Mhm.
So it's a difficult environment to say the least.
Yeah, absolutely. We're seeing the same thing at Five Star in terms of our underwriting. You know, one thing that I guess a lot of people in the multifamily space kind of gravitate to when they get to a certain point, and you guys are just about there, is you go from raising money on a specified asset on a deal by deal basis to saying, hey, you know, maybe we should just launch a fund and do like a 25, $50 million raise where, you know, now we're a private equity firm. The fund replaces the real estate. And now we can have conversations with investors 24/7, 365 days a year about the fund. And then when we see a piece of real estate, hopefully there's enough money sitting in the bank account for the fund for us to go out and act on it. Have you guys given thought to the fund model versus just buying real estate individually, one asset at a time?
Actually started the company. Fairwinds was actually started with the idea of being a fund, but a fund without a track record is very difficult to sell.
Sure.
So
Yeah.
we started doing the different individual assets. I've just launched my 506B fund. It's a B fund,
Yeah.
so I'm not going to talk about it. And it's going well. And then that'll be a catalyst for the next few funds, and then that we'll get to that point where we can do the 25 to 50 million in probably like a a Reg A or something like that.
Yeah, yeah. Well, I mean, a Reg A has a lot of challenges. You really got to have a marketing budget to be successful with that. And then, of course, the other big problem is, you know, when you're dealing with non-accredited investors, is the audited financials that the SEC wants you to have. And that's the
Yep.
big expense right there. Is a lot of people don't realize that, you know, once you start taking money from non-accredited investors, number one, the disclosure risk goes up tremendously, obviously, but also the SEC and a lot of the state regulators somewhat require you to have the same accounting infrastructure, or at least standards, as that of a public reporting company. And for a lot of people, that's a lot of money that they
Yes.
don't want to have to deal with, you know. So
Startup
that's
costs,
right
all
there.
that stuff. It's
Yeah.
insane.
Absolutely. Yeah, I mean, funds are the way to go, I think, you know, when you get to a certain scale and you have a track record. You know, when you look at the exit strategy for your investors, do you see yourself selling the properties individually one at a time, or are you looking maybe for more of a portfolio sale where you get a premium, where you just sell the entire portfolio of real estate to a much larger buyer? And as a result of that, maybe you're able to get a premium in the marketplace.
That's a great question. Right now, all of our exits are based on individual properties. Yeah, that's correct. Yeah.
You know, one thing that you might give thought to, and I learned this working for one of the country's largest self-storage operators. It's a great lesson for everybody that's going to be listening to this episode about the importance of branding. People don't recognize that when you create a brand and you really focus the marketing and everything that you do about that brand and the recognition of what that brand stands for, that brand will actually become much more valuable than the real estate. And so this is a true story. I actually worked for one of the country's leading self-storage operators, Michael Schwartz, who was the CEO based out of Laguna Niguel, started a company called Smart Stop Self Storage. And they're all over the United States. And he's the largest operator, actually, also up in Toronto, Canada. And he got to a point where he had amassed a portfolio of self-storage assets with a bunch of investor capital, probably at about 350 million. And he went to market. And so all of the big storage operators, Public Storage, CubeSmart, you know, Extra Space, Life Storage, started calling and saying, you know, hey, we hear that you're in the market. We'd love to talk to you. And he got an offer, and it was roughly $900 million cash. And he's just like jumping up and down, like, man, this is great. You know, he on the back end, right, with his 30% split on the waterfalls, like, man, this is sweet. But he said, look, you know, I got a responsibility to my investors, and I got to sit down with my board of directors and really kind of hash through this offer. But the funny thing is, about a week, maybe 10 days later, he gets a call from Extra Space, which I think at the time was the second, maybe the third just largest operator in the self-storage market. And they said, hey, you know, again, we hear that you're in the market, you're looking to sell this big portfolio, come on up. So they did. They put on their dog and pony show and they were offered 1.4 billion. And he's sitting there going, oh my God, like $500 million difference. What did they see that the other people missed? Like if it was 10, 15, 20 million, that's close, but a $500 million difference, there's something there. So he asked them just nonchalantly, like, hey, we got another offer on the table. It's a very generous offer, but we're leaning more favorably to yours because yours is a little bit larger. Just out of curiosity, what are you seeing in our portfolio that they've missed? And the answer he got changed his life. He said, Michael, we're not buying the real estate, we're buying the brand. He said, the name SmartStop is a recognizable brand in the industry. Every door on every property you own is blue. Just like Public Storage, they're all orange. And just like for us, they're all green. And it's the tagline. It is a smarter place to store, SmartStop. He said, that's what we're paying for. It's like Nike's got the swoop. It's like Apple's got the apple. It's like McDonald's got the golden arches. And he realized that when you build a branded portfolio of real estate and you go to market and you sell, you'll get a huge premium that's worth a lot more than the underlying asset. And so about a year later, he started investing in student housing and started buying properties, University of Michigan, Ann Arbor, Reno, Nevada, University of Nevada, all the big campuses all across the country, Ohio State. And he said, okay, if I'm going to do this again, I'm going to do it exactly the same way. So he created a name for the brand, called it Union Student Housing, but it's spelled differently. It's spelled YOUNION. And the tagline for the company and the brand is Union Student Housing. It's all about you, being the students that live there. And so his strategy is, we're going to get $300-400 million in student housing, sell it to a big buyer in the student housing space, and they'll be buying the brand, not the real estate. And again, we'll have a huge windfall because of the premium that we're able to command. So as you guys are going out there, building fair winds, buying property, launching the fund, remember that story, Jonathan, about building the brand and maybe doing something unique where the doors on every unit are all the same color across the entire portfolio. One of the best guys in the multifamily space that I got the pleasure of meeting a couple of years ago was John Williams, who was the founder of Post Properties. Post Properties out of Atlanta was the largest owner operator of multifamily in the entire United States. And he understood that concept better than anybody. He built Post Properties into a multi-billion-dollar company and then unfortunately passed away a few years ago. But branded real estate is the secret when you're building something big.
All right.
Little lesson for today.
Little company motto change here for me.
But the question I also wanted to ask you, which is real important, is, talk to me a little bit about, kind of what I call the back end of working with investors. There's investor relations, there's newsletters, there's annual reporting at the end of the year with tax information, et cetera, et cetera. How did you guys get to the point where you got a sense of comfort, so to speak, in handling all the stuff that comes with working with investors?
So it is a lot. We have to have our asset management team and our investor relations teams working together so they have all the pictures and the numbers and everything to work on. Then our marketing team has to come in, fit in with that so they can pretty up all of our newsletters and investor and communications to our investors. So obviously, when you first start off and you're doing everything yourself, you're hand jamming in your own newsletters, and now we've got all these different pieces of specialized people coming in together to put together a professional product for our investors. And that way we can do this on a monthly basis. We can send out the quarterlies, financials and everything like that, put together videos, update videos for our investors and things like that. Just as you grow as a company, you get everybody that is more experienced and specialized in their fields, then it becomes more robust as you go. I hope that answers the question.
Yeah, no, absolutely, 100%. And, the other thing also is, now that you're in real estate, and you're doing it obviously full time, in addition, like you said, to also having some interest in the Navy, but obviously not to the same extent that you did earlier in life. Looking back, what would you tell maybe your 20-year-old self as it relates to what you've learned in life, given where you are today, as a life lesson, or maybe something that you would have done differently?
Oh man. Well, I mean, 20 years when I was 20 years ago at this point, I've been like buy Bitcoin, but at the I would have really just gotten into real estate straight off the bat, straight out of college, and got the loan instead of waiting until I was 34 to get into real estate and taking lumps. Um, I would have told myself to get into commercial straight off the bat. I like the professionalism of the commercial side versus the residential. I spent a lot of time doing like dealing with the same kind of like we buy ugly houses type of stuff.
Yeah.
It's a grind. It really is a grind. So I would have definitely gone back and just gone straight into commercial. Really
Gotcha.
would.
Makes a lot of sense. One thing too, that I think a lot of people are exploring, we're certainly crunching the numbers, is people are making a killing in the short-term rental space. I mean, I've got friends that literally are going out, they're, buying single-family homes, they're staging them, and they're making $120,000 to $150,000 per property
Per year, yeah.
per year on a house that normally might rent for 25, 30 grand. So you're getting 3, 4 times the cash flow. We just had somebody on a coaching call last night that runs a TechVestor, which is a platform for people to invest passively in their fund in single short-term rental. And they got some assets that are making 200,000 a year on. And so, as a multifamily operator, have you guys considered taking a small percentage of the units in your portfolio?
We
That-
do.
Okay.
We
so
already
you're-
do that. Yeah.
you already do that.
Yeah, we've got so we've got like 6 units and under management, and we just started that up like 5 months ago. Like literally, it's just
And
amazing.
how's that going for you?
It's going fantastic. I mean, since I was like, hey, how can we just don't do all of our units like that? And Corey, our director of our commercial real estate, she's like, Jonathan, shut up with those crazy ideas.
Yeah.
You expose yourself too much, and then and then it just it can backfire. So we're growing out to the point where we're anywhere between 5 to like 7.5% of our portfolio will be done just like that.
Yeah. Yeah. I mean, it's amazing when you look at the numbers, and more importantly, you look at what it does to the NOI, understanding, of course, that commercial real estate trades, based on NOI and cap rate. And so if you're able to take a unit that might normally rent for $1,250, $1,500, and now you're getting $7,500 a month off that same unit, you do a couple of those in a property, people start wondering, like, how come your property is valued so much more than comps in the area? Well,
Yeah.
10% of it is all short-term rental. Our NOI is dramatically higher than what you'll find in a property that hasn't used that strategy before.
That's a fact. A problem that we've run into is that the lenders will discount
Yeah.
your short-term rental income. They won't count it.
Right.
So if jumping into like a refinance, it could backfire. But for like a sell, I mean, NOI is NOI. You know what I mean?
Yeah, no, absolutely, 100%. So talk to me a little bit about how you're going about getting in front of investors. Are you using multiple methods? Obviously advertising, because you can do that with the 506C. A lot of people are doing things on Facebook, LinkedIn, Instagram, creating webinars, things of that nature. Are you doing anything in the way of like live events where you buy a list and you mail to a demographic region and you try to get some affluent households or anything together? You doing any of that?
100%. All of it. All of it. You got to have as many funnels as you can possibly get. Emails, SMSs, Facebook, LinkedIn. We haven't dived into our own webinar, but we've been talking about it for some time now. So in the meantime, I've just been trying to jump on as many of these very valuable podcasts like this as I possibly can.
Yeah.
Same way for my other partners. We're all just trying to get out there, get the brand awareness as much as possible. The live events, my marketing guy is, or Vikram, he's been, Jonathan, you got to get live events going. So we were starting to have that going like every Friday. And We've got blogs that are going out. We've got, I put out our own, it's called a 8 Bells, which is like a
Mm.
bunch of short little videos of me talking about one little podcast, not a podcast, but one little topic here and there, and pumping those out on a routine basis, and developing the brand that is very Navy centric, like our Weekly Breeze is
Yep.
um, is our pod is our monthly newsletter,
Yep.
and just all that stuff that comes with brand development.
Looks like you've been following and listening to Grant Cardone, who understands marketing. Money follows motion, as Grant would say, right? So create that motion. People got to know you before they will flow you. They got to know you. They got to feel good about you guys. And, visibility in being out in the marketplace like you guys are, whether it's SMSS, whether it's a newsletter, whether it's a blog, whether it's a webinar, it gives you the perspective of, quote, you're everywhere, man. You're a lot bigger than you really are. Now, you might not be the big giant, but when people see you out there doing that stuff, and you've got a good brand and you're using that I call best practices, your materials look good, they're done professionally, people get a level of comfort. And that's ultimately, what they write checks for. They like the property, they like the people that are on the team, and then they move forward. And what I found in my career raising a lot of money is people will dip their toe in the water with you. They might have the ability to invest a lot more, but they'll be like, hey, on this first deal, why don't we do 50 or 75,000? And then, after they start getting some checks back, after they start getting their newsletters, they see that you guys have the act together, that you've got a sense and you kind of know what you're doing. The next deal you come to them with, now they open up their pocketbook and now they go to maybe 250 or whatever. And, the funny thing that I've always found about raising money is that the easiest way to raise more money is not to work harder. It's just to ask for bigger checks. And I think that a lot of people in the capital raising space, and this is a real big lesson for all of you that are listening to this, is you're somewhat intimidated about asking somebody to write you a check for like $250,000. But think about it. If you're talking to somebody worth $5 million, right? And they live in a nice big house, why not say, how much of this property would you like to take today, Jonathan? Can you see yourself doing 250? 500, 750, or do you see yourself doing nothing?
Yep.
Why start at 50 and go to 100 when you can start at 250 and go to $500,000? Worst thing that's going to happen is the guy might come back and say, well, why don't we just do 250 today? Or, I was thinking about doing 100. That's going to get you a lot more than the 25 or 50,000 if your offering is priced on a unit size of 25 or 50,000. See, the problem that I've always found with salespeople is they focus on the unit, or they focus on the share, the minimum investment of the offering. So if you have a minimum investment of 50, that's what you're focused on. No, go for 250, 500. You'll close out your deal a lot faster. And more importantly, you'll get much, much bigger checks.
That's so true. That's so true.
But it takes courage. It takes confidence. And, to be a closer, that's just what you have to do, is you have to ask for the larger tickets, and guess what? You will get them. Not all the time, but you'll get them enough of the time to make a really, really, really big difference. Talk to me a little bit about how people can connect with Fair Winds. Where can we find you guys?
So that's the best place. It's www.fwcinvestments.com.
Okay.
I would also love my personal email is Jonathan@FWC Investments. And you can sign up for our portal that way. You can email me directly. You can talk smack about Auburn. You can do, I don't care. Just email me. Love to talk to people. People are our best asset in life. It's all about who you know. So I want to know you.
It's all about connections. Absolutely. And you said you personally are located in Jacksonville. Is that where the company is based?
Well, our company is actually based out of Hampton Roads, which is where most of us lived up until about a year ago.
Gotcha. And so if you look at where you're located, just like here in Houston, for example, I live in Houston, Texas, but there are pockets of wealth where the people that live in Houston know, man, this is where all the rich dudes live. Like you go to River Oaks, You go to Piney Point Village, you go to Tanglewood. This is all the big $2-3 million mansions. These are partners in the most prestigious law firms in town. These are entrepreneurs that have sold their businesses for undisclosed millions, et cetera. Where you live, what is the most affluent part of town?
Oh, it's Ponte Vedra Beach.
Ponte Vedra Beach. Okay.
Without doubt, Ponte Vedra Beach. I live out in suburban sprawl here in St. Johns County. Nice house, but I mean, it's just suburban sprawl. But if you go out to Ponte Vedra and Ponte Vedra Beach, then those are the cats that they live on the beach in those like $10 million, $16 million houses, and that's the goal.
You want a little capital raising secret to get in the front door of all them big mansions?
Bring it.
You got to be a little bold to do this, but it works. And I've actually had students of mine that send me DMs after they do it. So in Ponte Vedra Beach, in the same little neighborhood where all them big mansions are, more than likely there's a Starbucks. And that's the Starbucks that all them Rolls Royces, all them big fancy BMWs, Porsches, Mercedes are pulling up to every day as those people are going in the morning to get their lattes. And so here's what you do. You go with one of your partners and you walk up to the cash register lady and you say, hey, here's my American Express or here's my credit card. You get a cappuccino and you say, watch us. We're going to go over there in the corner. And when I wave, the next person that comes up and every person thereafter, you say, today's orders, compliments of the two guys that are sitting over there in the back of the corner. And that people are going to be like, what? And they're going to turn and they're going to look at you and you just kind of give them that little head roll and that little nod. And out of curiosity, they're going to come over to figure out what in the heck's going on. And all you got to say is, look, my name is Jonathan. We have a big real estate private equity firm here in town. And personally, I always get offended when people call me in the early evening trying to pitch me a deal when I'm trying to spend quality time with my wife and my daughter. So we just thought a much easier way to introduce ourselves would treat you to a cup of coffee and a pastry on your way to the office today. Would you have interest in going deeper and getting to know more about us? And you will walk out of that Starbucks in 30 minutes with the business cards of some of the wealthiest people in town. And the funny thing is they're like, man, this is so cool that you would actually do that. And they're gracious. But here's the funny thing. A couple of days later, when you call them, there's a sense of obligation. You just spent $5-10 on a cup of coffee and a pastry, and all you got to say is, hey, this is Jonathan at Fairwinds. I'm the dude that bought you the cup of coffee. Oh yeah, I remember you. That was
Gotcha. Yeah.
But I'm telling you, you will get in the front door of the wealthiest families in town by spending a couple $100 at the Starbucks they all go to. And a lot of my students have done that, and they've DM'd me and they said, man, we raised $3 million in 3 weeks after doing that. It worked like magic. And it takes a little bit of cockiness and a little bit of boldness. But if you're willing to do something that is outside the box, right? Because you got to do it all. You got to do SMSs, blogs, go to the Starbucks in the wealthiest part of town in Ponte Vedra Beach and try that one day and see what happens. I want to get a DM or a text from you when you follow up in a couple of weeks and let me know what the results are.
Okay. Done. Challenge accepted, Brad.
All right, my friend. Well, thank you so much. You've been a great guest. I want to thank you for showing up on the Capital Catalyst Show, folks. This is where every week we host people that are raising money, investing in various sectors like real estate, like natural resources, like crypto, like Forex, etc. So listen in weekly, become a subscriber. And this is your host, Brad Blazar, saying, until we see you next time.
You've been listening to the Capital Catalyst Show with Brad Blazar, the best place for entrepreneurs interested in doing something big in life, having considerably less stress, and a more balanced life. Go to bradblazar.com for more ways to accelerate your success.